Good morning. How are you? This is Andrew Wilkinson with Interactive Brokers. Today, for this week's midweek podcast, I'm joined by Kevin Davitt, who's the head of index options content at the Nasdaq. Welcome back to the program, Kevin.
Thanks for having me, Andrew. I'm excited to be here as always.
You're not the only one who's back. We've got some volatility back, but put its return in context. We had a significant reversal in the market last week, a rebound on Monday, and then another fall, and then today being Wednesday, market's back up again. What is the current cost of protection, and what is it saying about where we are in the stock market?
Ooh, I really like the way you framed that and paying particular attention to the cost of protection element. In my opinion, that's a really foundational understanding if you operate markets using options. What do I mean by that? What is the cost of exposure if I want exposure to the upside, downside, or some kind of specific slice of the distribution of outcomes, right? Thinking in those terms. I also think we like benchmarks and I like analogies. So you go to Trader Joe's, the grocery store, whatever, and bananas are a quarter. It's easy for me to know if they're suddenly more or less expensive. Or earlier this year, the examples that were thrown around about a dozen eggs. With markets, it's less easy, but as many of your listeners probably know, implied volatility levels become that common denominator that allows you to evaluate the cost of exposure relative to some historical norm. Now, somewhat long-winded intro to your broader framing. So through yesterday's close, the cost of protection in the Nasdaq 100, which is where I focus my attention, it's higher than it has been for the past couple of months, but relative to a longer term view, we're in line with what's normal. Just to give that some sense of validation, the longer term annualized volatility, so we're talking about realized vol here in the Nasdaq 100, is around 21%. And we have the VXN, which is VIX methodology, but the inputs are the Nasdaq 100 options, measuring right around that level. Now, for those that live in the here and now and are looking for opportunity or potential opportunity, the question revolves around, was Friday's 4% high to low move off of all-time highs the start of another stretch of meaningful realized volatility like we saw in April? If so, then I would argue that the current cost of protection is reasonable, potentially cheap. But if we quickly move back, like the past couple of days have seemed, to the broader sort of trend of relatively muted vol, and we're not going back to an April environment, perhaps it's high. And that's the beauty of markets, is that you're afforded an ability to express your view as to whether things are relatively high or low.
Kevin, as you said, you live inside the realms of the technology market. I see you as a bit of a hobbit running around those corridors and opening doors and looking in. What's in here? What's in there? Where are you seeing pockets of strength and where are you seeing pockets of weakness within technology?
Oh, keeping it strictly within tech. That's a good question. Let's be a little bit broader, because both broader and narrow. Here and now, we are moving into earnings season. Mm-hmm. You have that generally led by big banks. Mm-hmm. And yesterday you had some comments out of Chair Powell, which sort of fueled some flows back into some areas that have been beaten down relative to big tech for quite some time, like the cyclical stuff like energies and financials and small caps. That has happened in fits and spurts for a long time. But bigger picture, this year included technology, which encompasses so many things, right? Technology touches everything, whether you're a big bank or an energy company. If I look at sort of the distribution of the big names that have powered markets largely for the past 3 years, it is interesting to see that since Friday's open, NVIDIA is the laggard and that is the biggest constituent in the Nasdaq 100 and the S&P 500. Through yesterday's close, the only name in that group that gets thrown around often that's higher is Google, but the broad market is off by like somewhere between 1% and 2%. So I will be looking to, and I don't want to poke into too many like specific names, but I will be looking toward 2 weeks from now when the names that we mentioned here and talk about in terms of big tech start reporting earnings, because I think that's where the rubber meets the road and where a lot of the talk around potentially frothy valuations has been centered. But for the past couple of years, earnings have kept up and exceeded expectations, and that has allowed the market to move higher, in my opinion.
There's been lots of chatter recently about irrational exuberance and comparing the current AI boom to the dot-com bust of the year 2000, Kevin. Do you think that's a fair comparison, or are there genuine reasons to believe that it's different this time?
Those are dangerous words. And there has been quite a bit of chatter. Of the coverage that I've followed, the corollaries from my standpoint that are most reminiscent of the late 90s involve some of the revenues or deals dependent on circular financing or vendor financing. That has been somewhat of a hot button topic lately. Mike Green, who is a friend and has an amazing Substack, did an interview on this recently. He reframed it in a way that really enjoyed. He highlighted the cash flow and debt levels, as well as the margins many of the companies that are employing this approach lately enjoy these days. And that swung my kind of mentality from this knee-jerk, yeah, that seems questionable, to maybe that is a much more thoughtful way to frame this conversation. So let me explain that a little bit. Things are so dramatically different for the big names that are driving broad markets relative to 25 years ago in the context of money making. So 25 years ago, the big drivers of markets were largely prolific money losers, and the market was valuing the potential for growth in time. And it did get out over its skis in hindsight. Very easy today to say after the fact. The companies mentioned today, whether it's like Oracle or OpenAI or NVIDIA or AMD, mostly with the exception of OpenAI, which isn't public, they're all cash cows. And I think the question becomes, and I alluded to this when we move into earnings for these big tech companies, is these companies that have significant margins and make a lot of money in 2025. They've been investing a great deal of capital into the infrastructure to support the continued growth of AI. Will they be able to monetize that? Will their margins diminish? Will we overbuild capacity? Like the sort of bellwether there was Nortel Networks back then, if any listeners are into history. I don't know, but I think it's a concern. And I would argue, and maybe I'm being a bit of a homer here, that one potentially very accessible way to manage that concern is using index options. And granted, I'm paid to think this way, but I also believe the market looks at it this way too, that the Nasdaq 100 would arguably be a cleaner expression of that concern, given the higher levels of concentration to most of the names that I mentioned there. That said, and this will be my last point, market timing is incredibly difficult in the short term, and over the long term, I would argue it's almost impossible. From an options perspective, I think that panic is easier to identify than market tops, like that complacency. It looks very different, and complacency and low volatility grind higher can continue for many years. So that's my very political kind of answer to, I don't know, but there are tools that your audience has access to, very liquid, and ways to spread your chips across time and tenors and exposures. And I think the audience, the world continues to become much more sophisticated about the way they can go about that.
What I'm really enjoying on my commute these days is I'm listening to on the BBC Andrew Ross Sorkin's 1929. Absolutely fascinating if you get a chance to listen to that, Kevin.
He's such a good writer and speaker, and I appreciate any sort of recommendations from you, Andrew. I look forward to that, and I got a flight later. I'm gonna be listening.
Excellent. All right, Kevin, as always, a pleasure. Thank you very much for joining me today.
Thank you for having me.
And to the audience, if you enjoyed this episode, there's plenty more. Wherever you download your podcasts from, subscribe to us there. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.